Hey, my name's Rajesh. I'm a direct lender based in Los Angeles, and today we'll be looking at how to turn $953,000 into $15 million over 40 years. Let's get into it. So there's multiple vacant units. The property will be delivered with two vacant units. So let's do some math here. We got to figure out which loan this will qualify for. So this is too many units for a normal DSCR loan. And a DSCR loan goes off of gross rents over principal, interest, taxes, and insurance payments. In other words, this is what it goes into. This is a DSCR loan. An agency loan looks at NOI over principal and interest payments. So DSCR loans are limited to 1 to 10 units. For us, we do 1 to 8 units with the DSCR loan in-house, and up to 10 via brokering. This is for our DSCR product. For an agency loan, we can go 5+ units. But for this, we have a maximum, or rather a minimum, 90% occupancy rule. Whereas on this, for 1 to 4 units, no occupancy minimums. And for these, even up to 10 units, or rather 5 to 10 units, whether we are brokering or doing in-house, our max vacancy is 2 units. So that's important to note. So we're on this particular 18-unit property, because it's already more than 10 units, this option goes away. So we're only left with this, and it has 2 units vacant. So we need to do 16 divided by 18 has to be at least 90%. So let's see if that's true. 16 divided by 18 is 88.8%. 88.88%. So it looks like for this, we would have to go private money. The underwriting standards are going to be exactly the same. Well, that's not true. For one of our products, we have a minimum 90% occupancy rule, but at application, minimum 85% occupancy. So you can still get this building. It's just that upon closing, you have to close that 1 vacant unit at minimum. That's the key. It needs to be 90% at closing. And then we'll go down to a 1.15x NOI over P&I. But So we can go on this, but you're dependent upon the seller filling that vacancy. If you want to fill those vacancies, then you will need to go private money. And we will explore both these options in this video. So let's see, it says a 6.15% cap rate. So we need to see these numbers here. So it tells me the gross rental income, the vacancy loss, other income, I'm not going to worry about that. So I'm just going to take this figure and subtract this to get my effective gross income. And then we're going to look at the net operating income minus this number right here. Okay. So first, let's see if this NOI is equal to 6.15% cap rate. So we're looking at NOI is equal to price times cap rate let's see here, NOI over cap rate is equal to price cap rate over NOI is equal to 1 over price. And that means cap rate is equal to NOI over price, because all you're doing is multiplying both sides by NOI to cancel them out. So let's see what the NOI is. It says it is 150,636, 150,636 over 200 or $2.45 million. Cap rate, and let's see what happens here. 150,636 divided by 245,123. So we are is equal to 6.15%, 1.48% to be exact, but 6.15%, which is what they have here. Now we're going to deduct this vacancy loss right here, 7,969. So 150,636 minus 7,969. Oh, no, we're not deducting this, sorry. We're deducting the other income, the 12,222. Because we're not going to count other income, even though it's coming from washing machines and laundry machines that the building owns most likely. We're still just not going to count that because we have to be conservative in valuing this. Machines break. $138,414. So this is our NOI. Now let's look at our gross rents. We are looking at, do they even mention a gross rent multiplier here? Potentially build up to 122 units. Okay, so we are looking at this one minus the vacancy loss. Okay, so let's see here, 265, 639 minus 7,969, 0, 13 minus 6, 15 minus 9, 14 minus 7, this becomes a 5, 5, 2, I believe. Let's see if my math is right. Yeah, this is our annual gross rent. Let's divide this by 12 to get our monthly. That tells me $21,472 a month, 21,472.5. So I'm going to round this up to 21,473 per month. And then I'm going to divide this by 18 to get my average rent per unit, which is $11.92 a month. $1192.91 or 92 per unit, and I'm going to round that up to $11.93 per unit. Okay, so let's see what this is. This is my NOI. I'm going to divide this by 12 to get my monthly. 138,414 divided by 12, 11,534.5, I believe. Yep, I'm going to round this to 11,535 per month. And now we can plug it into our calculator. So we are going 2, 4, 5, 1, 2, 3, 4, 18 units, 2 vacant units. We are looking at, what was the gross rents again? 21,473. 21,473. I'm going to put 0 there. And vacancy discount. So we're getting, we're not going to calculate market rents for vacant units. We're going to go based off the qualified rents. Let's see, property taxes check out, landlord insurance checks out. Here is our net operating income, 12,681. We actually need to get down to 11,535. So if I were to just do some simple math here, 11,535 minus, is it 11,535? Yep, minus 12,681, or minus 12,681, we get 1146. So we are spending $1,100, or we need to spend $1,100 more per month. So let's say here, if I were to increase gas to maybe 200, 200, 200, let's see, that reduced it a little bit, maybe 300 there, or yeah, 300 there on legal. That's probably looking more correct. 11,881 versus 11,535. So maybe another 300 on pest control. Now we're at 11,681 minus 11,535. So 11,535 minus 11,681. So I need to spend $146 more dollars. Where would I likely spend that? So 1146, or 146 plus 320 is 466. And now we're at a net operating income. So basically I just randomly added up these numbers just to ensure that the total net operating income shows 11,535. And now I can go to work. If we go 1.5 there, our minimum down payment is 31%. You're going to have to put at least 31% down just to make this work. And then you're looking at a 5-year CMT plus a spread. So 5-year CMT today. 3.842. 3.842. Oh, it's still at 3.844 plus 2.25. So we're looking at a 6.094. So we're going to punch in that new interest rate, and that's going to affect our down payment a little bit. So if I go 1.15 again, yeah, the higher interest rate means that you have to put down a bigger down payment just to hit these ratios, because the higher the down payment, the smaller the loan. The smaller the loan, the less the monthly payments. And in order to hit that 1.15 ratio, and this is at 6.904, it should be 094. So let's see here, 68%. So that's more correct. See, yeah. So you're looking at 32% down here just to make this property qualify with this loan. So let's punch those numbers in and see what we get. We're going to go 6.904. We're going to punch in this address here. Oops. Here we go. Let's move this here. As far as city goes, then we need the link. We're going 245, 1, 2, 3, 4. Okay, that's handled. Property management was handled at 8%. Down payment was 32% here. No mortgage insurance because this is an agency loan. No rehab costs, we're just leaving it as is. Now we got to figure out the economic conditions for this particular zip code. So we're in 90057. Average yearly appreciation over rate. There we go, we got it saved. We just got to update this zip code. So let's see what happens. And we'll go to google.com as well. So we are looking at 5.45%. 5.45%. Now we'll look up rental inflation. Average yearly rental inflation. So it gives me the, DuckDuckGo gives me the formula for CAGR, it just doesn't give me the answer. So it's still not at the point where it's able to read my mind. This says between 3.8 to 4.2, so we're looking at an average of 4%. And this might be RSO, so we'd be capped at 4% anyway. They had 2 vacant units, 88.88%. So 100 minus 88.88%. We're looking at 11.212, 11.12 vacancy. I'm going to leave this 0 for now, but I'm going to come back and fill that in so that we can get accurate numbers or prediction, model a proper prediction for future cash flow. So this is 18 units, and they were each, I believe, $11.93 per unit. Hazard insurance, 18 units, 18 times 1,100 per unit. So we're looking at roughly almost $20,000 a year in hazard insurance. Let's see what I put down for legal. Legal, I had it at $466 a month. Then gas, I had at $220 a month. Electric at 280. Did I do that wrong? No, that was water. Water is 265. Electric is 280. Lawn and snow, I'm going to include that in maintenance, so 2147. Let's put this at 0 for now. And I got to get this up to maybe 10%. 2147. This is 2147. Perfect. Pest control at 380. Advertising at $10. All right, those are our numbers. So our net operating income is $11,535 per month. If we were to do this, so let's see here, 142,538.56 divided by 12, we're at 11,878 per month. So we need to come down just a little bit. We need to increase an expense a little bit. So we're seeing property management at 1717. What are we seeing here? 1718. That's about right. Where are we short? Well, let's say 300 right there. Okay. So now it says 138,938 per month. Let's try this doing it a little backwards. 11535 times 12, 138,420. 138,420, so I'm still about $420 off, or $520 off. So let's see, 520 for advertising. No. 520 divided by 12. $43. So let's say $53 there. 138,422. I don't need this window, so I don't keep clicking on it. 11,535 divided by 12. 11,535 divided by 12. Oh, I'm 11,535 times 12. 138,420. Here I am, 138,422, which is pretty good. Our net cash flow with 0 vacancies, or rather using the same vacancies as this minus this without counting this, we're at a net cash flow of $17,000 from year 1, which is pretty amazing. That's pretty good. And if you were to just let it roll, not change anything about the building, and just hold tenants accountable and keep raising the rents 4% per year, after 30 years, your net cash flow pre-taxes is $3.3 million, $3.325 million. In your first 10 years, you're actually losing, or you're showing, not losing, you're showing negative net income, which because of all the write-offs, from the mortgage interest write-off to the building depreciation. That's also pretty good. But you're not going to be able to, if you were to try to sell it before year 10, at least according to this chart, you're not going to be able to see, you're not going to see any return on your investment. So somewhere between year 5 and year 10 is your break-even point. At year 10, you're making a $357,000 profit. But at year 30, if you were to sell everything, add back in your cash flow and then deduct the realtor commissions, you're looking at a $9.8 million exit. That's $9.8 million on an original investment of the down payment, which is $784,000, and all the closing costs and everything tied up with that. That roughly adds up to $953,000. So that is a 1,000% return on your money, or an 11x return on your money, which, to be honest, compared to some of the other videos on this channel, is not particularly great. If we were to do the Kager formula on this, Kager formula 30 years. Let me go to Google here. What does this say? As a percentage. .41% compounded. That's not bad, but it's not great either. So what can we do to improve this? So one way to do that is to actually pull out your original investment, because the less cash you have in the deal, right? So here is the basic idea. Here is your returns, and we're looking for cash on cash return. And here is your original cash. So that cash does not include all costs. It includes all costs that took your cash, where you had to take money out of your bank account and put it into the building. And the smaller this number is, the bigger this number is. So if I put like 100 here, and I put in $100, right, and my return was $100, my return is 1. But if I put in my return is $100 and I only put in $1, my return is 100. And even better is if my return is $100, but I put in only 1 cent, my return is more like 10,000%, or I believe like 1,000%. Let me double check here. 100 divided by 0.01, 10,000. Yeah. And so this is where the wealth is made, because you're putting in only a penny, but you're getting back $100. Putting in $1 and getting back $100, fantastic. Putting in $100 and getting back $100, at least you didn't lose anything other than your time. And with inflation, and if it's done over 30 years, you got to take that into account, because, that sucks. But if you put in $1 and you get back 100, that's not bad. But imagine you had $100, right? And you put in 1 penny here, and then you put in 1 penny in another one, right? How many times can you do that to really make that wealth? So let's say 100 divided by 0.01, right? So that's 10,000. That's 10,000 $10,000 opportunities. That's what it is. And that's where the wealth is made. So you got one opportunity that makes 10,000, that gives you a 10,000 X return, right? And then you do that 10,000 times 10,000. So you go 10,000 times 10,000 is equal to what? $1 billion? So that's 1, 2, 3, 1. That's 100 million. So if you can 10,000x your investment, your cash investment, you can get to $100 million using this. Whereas with this, you're at 100 times 100, assuming you have $100 cash with you. So 100 times 100 is equal to 10,000. So the difference between this and this is 10,000. So that's why we want to maximize our cash on cash return. So let's see here. How do we do that? We look for our total yearly spend. We add it to the balance of the loan, and we want to make sure that it's less than the max cash out LTV. So LTV stands for loan to value Mathematically, another way to express it is loan value. Okay, and many loans, they will, for commercial properties, they'll limit you to 70%. So loan to value has to be less than 70%. So what we're going to do here, in this case, the loan is going to be original investment, original cash, plus balance over the value of the building, and in this case, the future value, has to be less than or equal to 70%. And I like to, that's max cash out rules. I generally like to keep it at about 50%. So if you're somewhere between here or less than this, you're going to be cash flowing even after the cash out refi, which is important because you don't want to lose the money you just pulled out. But if you do, you're still getting a pretty big return, because the idea is that the money that you're spending paying for the losses in the cash flow is still less than what you originally put in. So let's see, the original cash here in this case is $953.39. 953 or 50, I forgot the number already. 953 339.42, and then I'm just going to assume year 10, because on big purchases like this, you're generally going to be about year 10. So year 10, your balance or your property value ought to be somewhere at 4.165. So we know 4.165, 162.26, and then we go plus the balance. So we look down here and we look at the balance on year 10. Year 10, the balance is $1,397,000. $1,397,000. 688.47. So we're going to add these together, divided by that, and hopefully it is less than 70%. 953,339.42 plus 1,397,688.47. That's 2.3 million, 2.35 million, and we're going to divide that. Let me write this down though. 235 1027 89 over 4165 162.26. So let's see what that equals. We are at 56%, 56.45%. That's pretty awesome. Now minus 1 will give us our LTV, or rather our down payment, for the purposes of inputting it into the calculator. So we are equal to 4355% equity. And this is LTV. So if I go here and I copy this value, right, and I put it as the purchase price, quote unquote, and I put in the down payment as 43.55, I ought to be pretty close. Interest rate, gonna assume it's the same in a few years because the LTV is low. That acts as a compensating factor. There's still an agency loan. So let's see what this looks like. So I'm just going to copy the figures from year 10 and plug them into the yellow boxes to make them, to sort of do that future modeling. So So that's going to stay our legal costs. So now I have to divide these figures by 12 to get them in here. 3532.88 divided by 12 is 294.41. I believe 294.21. Let's see what our water bill will be. No, 294.41. So we are at 4255, 4255.51 divided by 12, 354.63, 354.63. Electric is showing 4496.39 divided by 12, 374.70, 374.70. Electric, lawn and snow we're showing at 4817.56 divided by 12, 401.46, 401.46. Let me see what 5732, 5372.38 divided by 12, 447.70, 447.70, 447.70. Just making sure that I didn't enter the same thing twice. 6102, 6102.24 divided by 12, 508.52, 508.52. Advertising is showing 851 per year, 851.10 divided by 12, 70.93, 70.93. And so by staying conservative like that, by not pulling out extra cash, just enough to cover your original cash investment, you are now still cash flowing. And your cash flow after the 30 years, after doing the refinance, is 3.6 million. Your income write-offs are still more or less the same. And your exit strategy is 15 million, 15.2 million. You're going to get the sales price minus whatever you put in, plus the cash flow, minus realtor commissions, and you're looking at $15.22 million. Now remember, you pulled out your original cash investment, so you're getting $15 million for free. I want that to sink in for you, because you remember this, what we did here is the smaller this number is, the bigger the return. So after 40 years, or rather after 10 years, you pulled out your original cash investment, and then you're just letting it sit. You have a money producing machine from day one after the cash out refi. And yeah, your loan size has gone a little bit bigger than the original balance that was there, but you're not putting your own cash in. And that debt is being paid for by the rents that you're collecting and then some. So you're essentially getting a $15.22 million building for free. And now when you pull that original cash investment out, that's $797,000 that you had originally invested, right? Right here, the $794 that you had originally put down, your original cash investment plus closing costs came up to like 900,000 something, right? I believe it was, 953,000 right there. You take it and you do it again. That's it. And if you do that 10,000 times, let's see here. Well, let's say 15 million, right? We're going to stick with the 15.22 million. So let's say you do that 10 times. 15.22 million times 10. That's $152 million. Times 10 is $152 million. That's your exit in 40 years. Until